Tom Landhauser is our model portfolio specialist.
I think a good place to start probably is going to be, first off, what is a model portfolio and why you potentially want to use it. So I think that's a good starting point. So, I mean, starting at the top here, we all know what a stock or a bond is, right? You buy a share of Apple, you buy a share of Microsoft, you possibly buy a treasury bond, buy a municipal bond. You probably all know what an ETF or mutual fund is, right? A basket of securities, a basket of stocks, a basket of bonds, potentially a combination of the two, or some other assets, maybe commodities or something. So all a model portfolio is a professionally managed portfolio of ETFs and or mutual funds. In Invesco's case, on the Lifetime platform, we're all ETFs, which we'll get to in a minute. Now why? Why model portfolios? Model portfolios are probably the fastest growing segment of our industry in asset management by far. And I think there's a lot of reasons for that, but I think the primary reason comes down to one word: time. Right? There was a recent study that showed that advisors spend 15 to 20% of their time researching investments, building portfolios. That's a lot of time. I mean, the sheer number of investments to choose from these days, it's overwhelming. I'll throw it out there. I mean, just throw out some numbers. Can anyone guess the number of mutual funds and ETFs you have available to you and your clients?
Probably 35,000.
35,000. 15,000. Right? 15. That's not including share classes. So if you include share classes, we're probably north of 50.
But you're right.
Yeah. So I mean, just a huge amount of investment options out there for you to look at. So if you could outsource, right, the investment component of your practice, it frees up a lot of time. It frees up time for you to build and cultivate more relationships, perhaps do some estate planning that you want to do with clients, or focus on other segments of your business, right? So it just frees up a lot of time. So if you're looking to scale your practice, model portfolios are definitely a good value prop.
Because what you're getting is you're getting a team, the Invesco Investment Solutions team that is managing these portfolios, right? So how many people are on the team? Sorry, catch you.
Yeah, it's all right. It's all right. We have about 80 plus people.
80 plus people that are monitoring and working on these portfolios on a daily basis, and they've got all the designations and degrees and all the things they need to be in the right place at the right time. Maybe the question that I'll get to now is you think about like the different options that are on the Lifetime platform, and you've got strategic, you've got tactical. All of our portfolios are strategic in nature, strategic asset allocation. Why is that?
Sure. All right. So strategic asset allocation. Now I like to think of strategic asset allocation as core, right? If you're building a house, think of it as your foundation, right? It basically involves setting target weights or target allocations to different asset classes, then rebalancing those frequently through market ups and downs, right? So I guess the next question then becomes, how do you determine those target weights and those target allocations? And I think there's a number of factors, right? Clients' risk tolerance, clients' investment style, clients' time horizon, their investment objectives. But they're also driven by Invesco's capital market assumptions. So as Matt was saying, we have a team of 80 plus folks, PhDs, CFAs, oversee about 90 billion plus in assets, and a few of them are tasked with forecasting long-term risk and return for over 170 different asset classes, right? So that is also a driver of what goes into our strategic asset allocation. But how I want you to think about it, if you think about strategic asset allocation, think of it as long-term buy and hold investment strategy. That's how I want you to think of it. And why is it so important? And when we talk about asset allocation and strategic asset allocation, there have been a ton of research on this, numerous studies that show asset allocation is the primary determinant and driver by far of long-term performance, 90 plus. A lot of people think, picking stocks or timing the market, going in and out, we'll get to that after, but strategic asset allocation by far is the longest, is the largest determinant of your long-term returns and the variation of returns.
Core holdings, foundational holdings, that's the way that our models are designed, are to be core holdings. And as you mentioned, right, we're building a model portfolio with backing of the 80-person team that's forecasting where we expect markets to go, and we're really executing on that with the individual portfolios. So, now with the addition, what is it, we have to like nine portfolios now, I think, in terms of, we historically had 6, and as many of you know, we just added with 3 or 4 more models onto the platform, so we've got a full suite of models that Tom and his team are really tasked with overseeing. As we mentioned before, and you hit on it, in ETFs, right? That's, when we think about our models, they're 100% ETFs. We've been really excited to bring that onto the BFS platform. Can you talk a little bit about, how do ETFs benefit clients?
Sure. Okay. So ETFs, exchange traded funds, you've probably all heard of them. Very similar to mutual funds. I mentioned it earlier. Basket of securities in ETF. Few major differences though. Some big differences, and I'll highlight 2 or 3 of them. As the name implies, exchange traded, right? So you could buy an ETF just like you buy a stock. On the trading day, you go out there, you put the ticker symbol in, you can buy it at any time when the market's open, just as if you were buying a stock. Mutual fund, very different, as many of you probably know. When you put an order in for a mutual fund to buy or sell it, it's executing at the end of the day. The mutual fund has to calculate that net asset value, and then you buy it or sell it at the end of the business day. You'll find out your price. So the very nature of the liquidity of an ETF is, a nice attribute to have. But I think a lot of people focus on the 2 big ones. Cost, right? ETFs are primarily, now there are going to be some more, you're probably hearing about active ETFs, I'm not going to get into that. But ETFs are primarily, for the most part, passive, index-based, market cap index-based, or smart beta, which we'll talk to in about a second as well, just an index that's structured differently. Mutual funds, most of them, there's index-related mutual funds, but most of them are managed, right? They have a manager, you pay management fees. ETFs do not have those embedded management costs. So they are a lot cheaper for your clients to use. So that's a huge advantage. Second big one, tax efficiency, right? Last year was a great example of mutual funds. I'm sure you may have had some of these uncomfortable conversations with your clients. The mutual fund might gain 10% for the year, and then they get hit with a capital gain at the end of the year. That's always a fun conversation. ETFs, you're really not going to run into that issue. You can have a whole session based depending on how they're structured and why they don't have these tax inefficiencies. They generally will not pay capital gains to your clients. So for taxable accounts, not that big, retirement accounts, not that big a deal. But for your taxable accounts, ETFs are going to be a lot more tax efficient. So those are the 3 big ones that I think when we think of ETFs and the advantages. Now looking at Invesco, we're huge in the ETF space. 4th largest ETF provider by AUM, manage over $430 billion globally, 360 of that is in the US. And diversified. We have ETFs across the spectrum, fixed income, bonds, equities. I think it's 200 plus ETFs we have now. So point being is we could build a very strong, diversified portfolio with the Invesco lineup of the case.
So they're going out in those 200 ETFs, and they're only selecting the one that they feel the best players to put on the team. Right? They've got the whole lineup to choose from, and they choose what they feel are the best ones that they can execute where they think the right ones should be. You look at the other platform providers on Lifetime, and they're using our ETFs, and then putting the fee on top of them. Because we use our own ETFs, a big benefit is that we don't have a management fee for our model. Let's jump in a little bit more into ETFs, and especially because the name is in some of the portfolios, which is smart beta. Can you talk a little bit about what is smart beta?
Sure. Okay. Smart beta. Get a little complicated. I'm trying to keep it simple. When I think of smart beta, the simplest way I can explain it is an investment strategy that uses different factors to weight an index differently than your traditional market capitalization. Let me give you an example. I think that's the best way to understand it.
Real quick, what is a market cap?
Yes, that's what I'm getting.
Okay.
All right, we all know the S&P 500, probably the most known index in the world. 500 largest U.S. companies make up the S&P 500. SPY is the ETF that tracks that index. Probably the most known ETF in the world, largest by far. Now, the S&P 500, SPY, is market cap weighted. Okay, what does that mean? That means the largest companies have the largest weightings in the index. Okay? Apple, largest company in the U.S., the largest company in the world, $3 trillion market cap, okay, has the largest weighting in the S&P 500. I believe it's about 8% right now. Second largest holding is Microsoft. And they're about a $2.5 trillion company, right? 7% weight in the S&P 500. What if you didn't want to own those 500 stocks based off their largest, being the largest, but on some other factor? What if you wanted the highest quality companies of those 500? And quality in our industry is measured by numerous attributes: return on equity, very low debt for the company, a number of other things. So what if you could generate a quality score for each of the 500 companies in the S&P, and then weight those based off the highest quality companies in the S&P 500, right? That is an example of smart beta, okay? Our SPHQ, which is in all the lifetime models, is the S&P 500 quality ETF, okay? There's also other ones, low vol, weighting based off of the volatility. The lowest volatile stocks have more of a weighting. So if you have a risk-averse client, you don't want the top weightings in maybe a lot of the technology companies, but more in utilities and stuff like that, those are going to have higher weightings. You can weight it on value, the cheapest stocks in the S&P 500, from multiples. So there's numerous ways you can weight it, but that's an example of smart beta. Now, the one other thing I think I'll mention, you see this mix of active and passive, and how do you get there? I've been doing this a long time. I've never met a portfolio manager when they're managing their fund and screening stocks out there that are screening based off of the lowest quality stocks that are the most expensive. I'm a portfolio manager. I want to buy the lowest quality stocks I could that are very expensive. It's not happening, right? I mean, it never will happen. So this rules-based approach to investing that smart beta is, right? They call it rules-based, is a way to get very low-cost exposure to that active kind of component of investing, if that makes sense.
Active selection is not necessarily active management, because it's not the same. It's active selection. And typically in a smart beta strategy, it could be rebalancing or reconstituting, which just means they're changing the stocks that they hold on different time frames. It could be as short a time frame as monthly, or it could be annually, it could be quarterly, or every 6 months. It just depends on the strategy, but that's the mindset of the active selection and the quote-unquote passive. Let's jump into the models and talk a little bit about, we have a couple slides here on the strategic balance versus the smart beta. So kind of walk us through the two types that we have.
Yeah, okay. These are our strategic balance models, the ones a lot of you know and love, all on the lifetime platform, $25,000 minimum for each of the models. How I like to look at these three models is we do it for you, right? We build it for you. It's a complete portfolio for your client. U.S. equities, international equities, and fixed income. We actually have some small caps in there as well. We have the conservative growth, which is, as the name implies, a little bit more conservative, 60% in bonds, 40% in stocks. The moderate growth, which is the most popular of the three at Primerica and the most bought, is our moderate growth, which is your 60-40, 60% in stock, 40% in bond. And then your one that's a little bit more aggressive, your growth strategic balance, which is 80%, 80% stock, 20% bond. These are the underlying characteristics. As Matt was saying earlier, the models are all Invesco, all ETF, very low cost. Average weighted expense ratio on these models, 30 basis points, and no overlay fee. No overlay fee. A lot of our models have to charge overlay fees. They don't have the ability to, like Invesco, who has a lot of product, to build a model, they have to use outside managers, and they need to make money or charge an overlay fee. We don't have to do that. They are potentially rebalanced quarterly, based off of some of those weighting mechanisms I mentioned earlier, strategic asset allocation, target allocations. So that's looked at on a quarterly basis. So those are the strategic balance, those are the models, the underlying holdings.
When we're not afraid, we're not afraid to make changes when we see opportunities. For those of you that invest in these strategies, you know a couple times last couple of years we've changed the underlying holdings because of market dynamics or different types of opportunities that we want to take advantage of. You know, he said, again, this is, we will do it for you, right? The two types of advisors that I would say would be looking to use these types of models would be those folks that say, look, for anybody that's below, call it $100,000, but still meets the lifetime minimum, use this. You don't have to worry about multi-managers, you don't have to worry about combining strategies, we'll do it for you. We will build a complete portfolio for maybe some of those lower dollar amounts. Or, let's say, even for some of your better clients, again, you want to outsource that investment capability, let us do it for you. We'll use our 80-plus person team to do exactly that. That's where I feel like these strategies, these three strategic balance fit in, is either the lower dollar amounts, or if you want us to do the investment. And then the other three, those here, are kind of the other side of the house.
Yeah, so smart beta models. Now, you can think of these three as do-it-yourself, right? Now, these are kind of the pieces, right? You have global equity, which is all stocks, but a mixture of U.S. and international. You have the U.S. equity, the most sold model of Invesco is at Primerica by far, very popular. And then the all-income, that's all bond. So for conservative investor, looking for fixed income, looking for yield, that would be your option there. So you have the ability to mix and match here. Now, recent change is the smart beta suite. They moved the minimums down to 5,000. I believe you still need 25,000 on a platform, but 5,000 you can do with each model. So if you wanted to put 15,000 into global equity and 10,000 into smart beta income, you can do that. So this is more of a do-it-yourself type of approach.
And we added a couple additional models at that lower minimum too. So again, you think about what we're offering in that additions that we have, the cornerstone models, are at that lower minimum, right? So they can also be great options for some of those lower dollars. But you think about smart beta U.S. equity. That is, as Tom mentioned, that is by far the most popular strategy. And the reason why, it's a core U.S. stock pool. People ask me all the time, like, who should use this? What type of client is this good for? Smart beta U.S. equity, if you're doing the investing yourself, if it's your higher dollar amount clients, if you're combining managers, smart beta U.S. equity is the core U.S. stock exposure for anybody that needs stock exposure in their account. And the reason why is because Tom and his team are going to build a well-diversified U.S. stock portfolio. A good mix of growth, a good mix of value, a little bit of small and mid-cap. We're going to use some of the smart beta strategies. It is a go-to core holding for anybody that needs U.S. stocks. Can you walk us through a little bit of the holdings in terms of what we own in that strategy?
You mentioned a few of those changes. A lot of you may be familiar with QQQ. That's a huge ETF out there. It wasn't in the model 50 years ago. The enhancements of putting it in there, you can see it's a large percentage of our U.S. equity. High exposure to the NASDAQ stocks, on tech in there, consumer discretionary. That was a great enhancement by adding the Qs to the model. So that strategy is representative across the board. I mentioned that S&P 500 quality ETF for a little while, and some of those other factors. So in a down market, like we had last year, you had have portfolios hold up relatively well with these low volatility strategies, quality. That attribute of a portfolio, we mix up quality companies tend to hold up better in down markets. We added our multi-factor ETFs in OMFL and OMFS, which are both category killers. They use a little bit of a tactical component, which I'll get into in a second. But yeah, a lot of enhancements to the models. And that's been reflected in, I believe, performance, although short term.
Yep. Well, and I think just to reiterate, you know, we talked about the NASDAQ 100, right? QQQ, how many of you have heard of QQQ or seen the advertisements, right? QQQM is the same thing with a lower expensive fee.
Only difference.
Literally the only difference. You get the exact same holdings, the exact same stocks, of all the commercials, from all the advertisement that clients and prospects see, you get all of that for a lower expense rate. And I think it was at that time, I don't know if it still is, but when we made the addition, you all were the only firm that we put that into a model. Like that was the first of any of our model portfolios to use that, and as mentioned, you know, 26% of the portfolio, QQQM is up to 41%. So I guess that's a good, oh, go ahead, your question.
I just have a quick question. This seems like a decent time to ask it. I've been wondering about international. So is there a story on it? I mean, are we ever going to come back to it?
Yeah.
Wait, what do you
Listen,
think?
we have a bias towards U.S.-based companies. We do. If I talked about a strategic asset allocation we have, we are a little overweight U.S. International has been out of favor for 20 years.
Yeah.
You know, at some point you would think it would be coming back. I think there are some, you know, things that are in play to start seeing maybe some international performance if the dollar starts to weaken and so forth. So I think it makes sense to have some inclusion in there. So it's a matter of how comfortable your clients are with it. So those smart beta models, you know, if you're not comfortable with the amount of international exposure we have in the strategic balance, you can build yourself and do it yourself. But we feel that international should be part of an overall diversified portfolio, but we understand how some clients may just want to stay U.S. based. Don't know if that answered your question. Hopefully.
Yeah, absolutely. I was looking for maybe you were going to say it's coming back. You know,
I learned my lesson
that's
like
great.
5 years ago. But you know what? Now that everyone stopped talking about it and has given up on it, that's probably when it's going to start performing.
Yeah, sure.
Maybe last part, and we'll open it up here. The multi-factor, the dynamic multi-factor. Can you go into that a little bit? Because I think that's so unique and so different.
Yeah, so I thought, you know what, let me start.
Yeah.
We're going to talk a little bit about tactical.
Yeah.
So we mentioned where it's strategic, right? Long-term buy and hold, that core of the portfolio. You have other managers in lifetime that are called tactical. So what's tactical? They're more short-term in nature. They're trying to capture market movements over a short period of time, which could add some value to your portfolio, but it's very difficult to do as well, to get that timing right correctly. So if you're looking to complement us with another manager on lifetime, you know, if you'd like a tactical manager, I say go ahead, go for it. Horizon does a good job, like a Leader, Sage are on the platform. But I wouldn't make that the bulk of your portfolio. It's very, you know, hit or miss if they get their calls right with that tactical approach, right? So I just wanted to make that point. You had mentioned about dynamic multi-factor, OMFLs, Russell 1000, and basically we are tilting the portfolio there, not based off of where we are in the economic cycle, right? So if we feel we're based off of leading economic indicators that we're in the recovery phase, right? We will tilt more towards, you know, growthier stocks, stocks that perform well. If we feel we're in a contraction or we're going into kind of a slowdown, we might be in more quality type names, or we might be in more lower volatile names. So it does have that tactical component there. So this is not a tactical allocation, but within the portfolio itself, you do have some of that tactical component, which I think is good, because it adds conversation with your clients. If your clients are asking you, like last year, well, what are you doing with my portfolio? You know, your market's going down. You can mention, you know, there's a couple of underlying holdings that will adjust the OMFL and the OMFS based off of, you know, slowdown, recovery, contraction, or expansion. I guess just a few more closing comments, and I'll open up for Q&A. I always like showing a few. I think these charts are very interesting, and they're good talking points, good stories when you're sharing with clients. I guess I'll go back to this one. these are 20-year returns, the last 20 years, and we started in 2000, and that was a very bad year. It started 2000, 2001, 2002, were very bad years in the market. But a lot of these slides, what they're going to point to is it's time in the market, not timing the market, right? Very important. The average investor behavior, they've done studies with redemptions and mutual funds and ETFs, and then when they take them out, when they put them in. The average investor for the last 20 years has only made 4.3%. If you just stay in U.S. stocks, it makes 6.6, not touching. So investors want to do, what do they want to do? They want to buy high and sell low. They buy on, sell on fear and buy on greed, and should be doing the exact opposite. I think this one's pretty interesting.
And we did, I went through this one on the navigating volatility deck.
Oh, you already did?
So here's the thing, that navigating volatility deck is included in the lifetime presentation. So it's a really cool way to
Oh,
think
you
about.
did all these slides?
Yep.
Just to get you?
Yeah.
All right, I got some. Yeah, come on. I'm going to Mohegan Sun next week for a Primerica event. This slide really stuck out to me. I love this one. So when people say that, stock market is stock market is a casino, you're just gambling, right? So I think this is a So these are the odds of winning different casino games. On the left, 40% slots, 23% casino. And you notice like the hotels give the comps and free rooms to the people that get slots and casino the most. The other ones, not really. Blackjack, craps, baccarat, best odds. Anyway, over the last 120 years, on the right-hand side, any 15-year rolling period you can come up with, you basically essentially never lost money. 10 years, any rolling 10 years, from 99 to 2009, so 89 to 99, 10-year period you could come up with, 97% of the time you've made money. Maybe even 5 years, 90% of the time is impressive, right? So, point being is, I think it gets lost this day and age. Everyone's so short-term focused. They want to trade the market and all that. If you stay invested, stick to a plan, you're gonna do okay. It's not a casino. Investing. I think sometimes they make it into a casino. If you're watching CNBC and all they're talking about trading options and stuff like that. So I think it gets lost. And you have to kind of bring your clients back down to earth and kind of set out a plan and.
Any municipal bonds in there ever?
Taxable munis.
Taxable, yeah.
Yeah.
We don't have a tax-aware fixed income.
All right. Perfect, thank you.
So the U.S. all cap equity compared to like S&P 500 as a benchmark, which y'all's goal is? Would y'all's goal to be to outperform the benchmark over time?
Yeah, the U.S. equity?
Yep.
Yeah, so I mean, if you think about the S&P 500, right? First off, it's all large caps, the largest companies. I think the nice thing here is we have some small cap exposure on the U.S. equity, which we like. Our capital market assumptions favor small caps over the last 10 years. So you're getting some small cap exposure where you wouldn't be getting that dynamic multi-factor that we talked about. That OMFL has destroyed the S&P 500 over the last 5-6 years based off of its tilting towards different market regimes. So I would say those are the two biggest differences on the U.S. But yeah, we're looking to outperform significantly the S&P 500 this year. I'm sorry, follow-up question?
Real quick. Are ETFs impacted by redemptions anywhere like mutual funds are?
No, I mean, it's not, it's a different trading mechanism. And it gets a little complicated with the inner workings and these authorized participants, but no, you're not commingled and getting hit like that. It's really more of an individual type.
The simple way to describe it would be on a mutual fund, it's a buy or sell that's happening, right? Whereas on the ETF side, it's an impact exchange.
So in a down market, when there's higher redemptions, you don't have to hold a higher cash position because of that. Because you're not holding any cash position. Okay. Is that true?
Yep. Yep.
Okay.
2.5%.
That's just 2.5%, could be just dry powder, just say,
Yeah.
have something there.
Well, all of our managed accounts, I think, hold about 2%.
Yeah.
Okay.
Yeah.
Someone had a question over here?
Yeah, you kind of touched on it a little bit. I was going to ask, most of it was, over time growth-based conversation, but I was going to ask if there was any, advantages that one was draw or.
Yeah, no, I mean, not really. I mean, ETFs have a lot of great characteristics, and especially when it comes down to tax efficiency. And, again, a lot of, run into some of the issues that we may run into.
And again, the smart beta is equity, why it's been the most popular is since we made those enhancements to the strategy, back to 2021, I think we were the #1 manager on the platform. 2022, we were number 4, and to start the year in 2023, we were number 3. And so it's just been, in terms of adding in the different strategies and how the team has managed it, we've seen some great results, and that's why it's been by far away.
I have a question. So if ETFs have tax savings, I guess, if they are actively selected, right, the companies that are within the ETFs, if they're lower fees, it sounds like the only difference really for the client would be the managed piece of it.
The active management.
So then, but it leads me to wonder, I guess, how much value, and this might be a dumb question, but how much value is the management compared to not having it, right?
Yeah, yeah. I mean,
There's
that's
a big can of worms and a big comparison.
Yeah, but that's a good way to think of it, right? Now, what's interesting is a lot of active mutual funds now are coming out with ETF wrappers. So I'm not gonna get into that now, but you're gonna start seeing more active ETFs, which takes away another advantage, or gives another advantage to some ETFs. But
In our fixed income ETFs that we have, the next CPM we're going to talk, we actually have an actively managed bond fund.
yeah, and there's a lot of, listen, I mean, there's asset classes that, favor active, that, passive has been, had a very hard time to kind of outperform. So there are active managers that do a fantastic job. So to answer your question, yeah, that would be really going to be, benefit there, the active management, and what they're able to deliver. The wrapper itself, a lot more advantages.
Tom, thanks so much for your
Yeah.
time. I appreciate it.